So I just got a question about dividends and interest. Someone was asking about their whole life insurance policy. They said, how do the dividends and interest actually work? I hear that I'm paid dividends and interest, but when I look at my life insurance policy, if I look at the illustration and I see you received a dividend of $1,000, what does that dividend actually include? Is it just the non-guaranteed portion, or am I getting dividends and interest? It's confusing, and frankly, it is confusing. So in this video, I am going to do my very best to break it down. Let's have some fun. So when I get a whole life insurance policy, the company that I pick will usually publish a dividend interest rate. So you'll have what is called a dividend rate. And a lot of times you can Google search what this is, especially with the top companies. So if you looked at some of the top companies like Mass Mutual, Guardian, New York Life, or Northwestern Mutual, New York Life's at a 6% dividend rate, Mass Mutual's at 6.1%, Guardian's at 5.9%. They're all right there in the race with each other. So let's pretend for this example, you have a policy with a company that has a 6% dividend interest rate this year. So how that dividend is actually made up is like this. You've got your minimum guaranteed interest rate. So this is your guaranteed floor. If the company paid no dividends, you would still receive this. Let's assume you have a product that has a guaranteed rate of 3%, which is very common with new whole life insurance policies today. So what that means is if the company has a total dividend interest rate of 6% this year, you are going to receive what is called a surplus. And to keep things consistent, let's call it a surplus rate of, guess what? 3%. Where that comes from is we know what the total dividend rate is, 6%. We also know what the guaranteed rate is on our product. That is made known to us when we first get the product. We can see it in our formal contract. Your agent can also let you know. And then the difference between those two reflects the surplus rate. Here's the important piece right here that clarifies how this all works for a lot of people. The surplus. When you look at a life insurance illustration, the surplus piece is referred to as the dividend. So you'll see a column on a life insurance policy or life insurance illustration that says annual dividend or end of year dividend. That reflects the surplus piece. Do you think that's confusing? I do. Here's why. If a company tells me that they have a 6% dividend interest rate, and I see on that company's life insurance illustration a column that says annual dividend, what am I going to assume that that annual dividend represents? 6%, because it's the same term, dividend rate and annual dividend, but it doesn't work like that. The annual dividend column, so again, this is on the life insurance illustration, reflects everything, here we go, above the guaranteed rate. So the guaranteed interest is not reflected in that dividend column. Now, sometimes when we go through that, I either get, okay, got it, that makes sense, or what's my bottom line? So I'll show you both here. We'll look at the bottom line, but first, I just want to go through what I just covered above on an actual life insurance illustration, and then we'll look at it on Excel along with the bottom line. So looking at a life insurance illustration, here we go. What we've got, this is a 44-year-old individual. He is funding the policy with $30K per year. But what I want to focus on here is first the funding, $30K per year, so you can see exactly where his money going in is. Then over here, You've got his money column, net cash value. That's the most important column to most people. Like, that's the money that you have access to. It's your cash. And then you've got your death benefit. This is the money that's paid out when you die. But highlighted in yellow right here, look at this, end of year dividend. Some illustrations will say annual dividend there. So a couple things here. You'll notice in the first year, there's no dividends. Most insurance companies, most, not all, but most insurance companies with most products do not pay a dividend in the first year. Beginning the second year, we see that they pay a dividend. And we see that it gradually increases over time, which is really, really nice. However, that dividend reflects what? This insurance company's dividend interest rate, this is with Guardian. Their dividend rate for 2024 is 5.9%. Does that dividend rate reflect 5.9%? It does not. So this product with Guardian, the guaranteed rate is 3%, which means the surplus was 2.9%. That right there, that surplus of 2.9 is what is showing up in that end of year dividend column. So it is not reflecting the total earnings that you have in a life insurance policy. That's the big thing to be aware of. When we hear that term dividends and interest, how I like to explain it, because this is how I like it explained to me, is the interest portion, I'll consider just the guaranteed piece, and then the dividend, I'll consider everything above the guaranteed interest. So what's my bottom line? Here's the easy way to do it, where you don't have to try and see exactly what the guaranteed interest is, what the dividend is, because you won't get all of that from a life insurance company. What they tell us is what the surplus is, which is the dividend column, but do you see the guaranteed interest anywhere? You don't. And you typically do not see that with life insurance illustrations or on your online portal, your annual statement. Like, they're not going to give that information. So what you can do is calculate it. So what we can look at is your cash value. And we're going to look at this exact same illustration, but on Excel. Let's have some fun. So here we go. There's your first year cash value. When we look at this guy, 30 goes in. You've got just about $26,000. What is your money growing by? That is the question. Here we go. Cash value growth. Now the first year, negative $4,100. We didn't see that on the illustration. Where I got that from is here. First year, this is you. You paid $30,000. You have $26,000, which means you took a loss of that dollar amount right there. Did you get guaranteed interest in the first year? You did, but your net numbers are still a loss there. What you would actually see happen with a lot of life insurance policies is you pay the $30K the first year. What you see, I should say first day, what you might see is, call it $25,000, just making numbers up here, estimates. And then by the end of that year, so day 365, then you see the 25,893. So the guaranteed interest pushed the value up a little bit. Some companies will do it that way. Some just tell you, here's all your guaranteed interest up front, and it doesn't move over the course of the year. But we do get some of that guaranteed interest during the first year, which might alleviate that negative hit a little bit. However, it's still a negative hit. Like, that's how I look at it. I have less than what I paid in. That's what's important to me if I'm the policyholder. The next year, what do you notice here? Well, I had $25,893 at the end of the first year. I paid $30. Now I've got $56,215. If you just take $25,893 and add 30 to it, you would get $55,893. However, you have $56,215. What that means is you got your 30 back plus a net of $322. Now, if we go back to that illustration, the dividend in year 2 showed $12.82. I didn't get that much net. This is what can be really confusing to people. Where the $12.82 comes from is if I looked at my policy at the beginning of the second year, instead of $56,215, I might see, call it, what would that be? $55,000 or so. And then at the end of the second year, I get that dividend, which is the surplus piece. I'll call it $1,200, and that's what gets me to the $56,215. I had 55, I got 1,200, now I'm at 56,200. So I know it's confusing because I've been confused many times with this. What I like to look at, and do let me know if this helps simplify things, is simply what did I pay in and what did I actually get from the insurance company net? Because this simply shows how much the cash value is growing by each year. And this is going to exceed the dividend column by a lot as time passes. In year 2 and year 3, it might not, but from that point forward, it's going to get better and better. So if I look at year 10, the dividend column is $63.11. And then down here, in this example, year 10, when I look at my policy, because again, this is the exact same thing. There we go. It's almost double, about 12 grand, as opposed to that dividend column of $6,000 and change. The reason why is because this cash value growth column, the company didn't provide it, we're providing it here. This displays the guarantee and the surplus, which again is that actual dividend column on a life insurance illustration. So let's call it div column. But this is just giving you your net number. Now you can get some reports from insurance companies that are similar to this. You'll see it's called a net cash value increase column. I don't always like those because in many cases those that includes the money you pay in. If I just want to see the net dollar amount I got from the insurance company, this helps a lot more. With that said, I do hope that this was helpful, just providing clarity on how dividends and interest are applied to the insurance company. If we're going to wrap it up, I would do exactly this. So the interest, let's call it the guarantee portion. And then the dividend, let's call it the surplus. And then down here, we've got the total, which we can calculate the dollar amount. And if we want to know the total rate, that would be called the dividend interest rate, which we would see published by the insurance company. Not all insurance companies publish them, but most do, especially the top companies. But that's how I would look at it. And lastly, don't expect the dividend rate to equate to the actual net return. A dividend rate, if it's 6%, might give you a net growth rate. Pen's not working. There we go. Might give you a net rate of somewhere between 4 to 5% after we get over those negative years. So I hope this helps. Let us know if you have any questions at all, and thanks so much for watching. Have a great day.